Hello and welcome to this session from AARO Academy. In this session, we will explore the crucial process of preparing consolidated financial statements under IFRS 10. This standard requires that entities that have control of one or more entities prepare consolidated financial statements. It provides guidance on identifying control and guides entities on how to present and prepare consolidated financial statements. Preparing consolidated financial statements is a cornerstone of compliance and transparency in today's interconnected business world. Consolidated financial statements combine the assets, liabilities, equity, income, expenses, and cash flows of the parent and its subsidiaries as those of a single economic entity. They provide stakeholders such as investors and creditors with a comprehensive view of a group's financial health, enabling informed decision-making and resource allocation. However, the process can be challenging. Manual consolidation often leads to inefficiencies, errors, and compliance risks. In this video, we'll explore the 7 key steps to preparing consolidated financial statements and demonstrate how AARO consolidation software can simplify these processes, minimize errors, and enhance efficiency. The 7 steps we'll cover are: first, establishing entities to include in the consolidated financial statements. Next, collating the financial statements of these entities. Then translating the financial statements into the group presentation currency. After that, combining like items of assets, liabilities, revenue, and expenses. Following this, eliminating the parent's investment against the subsidiary equity portion. Subsequently, eliminating intercompany transactions, including unrealized profits. And finally, allocating profit or loss between the group and non-controlling interest, NCI. Let's dive into each step and explore how automation can make these tasks more efficient. The first step in the consolidation process is to establish the entities that should be included in the consolidated financial statements. According to IFRS 10, all entities controlled by the parent, whether directly or indirectly, must be consolidated. Control is defined as the ability to direct relevant activities that significantly affect an entity's returns. While control is typically presumed when the parent holds more than 50% ownership, entities may also exercise control through mechanisms like potential voting rights or contractual agreements with other shareholders. For example, a parent with 40% direct ownership may consolidate a subsidiary if it holds additional voting rights through agreements that result in effective control. AARO consolidation software simplifies this process by maintaining an up-to-date database of all subsidiaries, including the percentage of both direct and indirect ownership. Automated workflows ensure compliance by flagging changes in ownership or control and including only eligible entities in the consolidation. The second step involves collating financial statements from all subsidiaries. This process requires that all entities within the group align with the group's accounting policies, even if they initially report under different frameworks, such as US GAAP or K3. Adjustments such as reclassifications or changes in measurement bases may be necessary to align with the group's policies under IFRS. AARO consolidation software facilitates this with multi-entity integration capabilities. Subsidiaries can upload their financial statements or integrate directly with their accounting systems. For example, the system can track discrepancies in reporting formats, flagging areas that require alignment, while reducing manual effort and ensuring consistency. The next step is to translate the financial statements into the group presentation currency for subsidiaries operating in jurisdictions with different currencies. This requires compliance with IAS 21. According to IAS 21, items in the statement of financial position should be translated using the closing rate, while items in the statement of profit or loss should be translated using the average rate. AARO consolidation software simplifies this process with a built-in exchange rate register that ensures the relevant exchange rates are automatically applied. It facilitates accurate currency translations by maintaining historical and current rate data, automating compliance with IAS 21 requirements. Additionally, the software can handle complex currency scenarios, such as multiple exchange rate types, or reporting for subsidiaries with hyperinflationary economies, reducing manual effort and ensuring consistency across all entities. Once all financial statements are in the same currency, the fourth step is to aggregate similar line items such as expenses, revenue, assets, liabilities across the parent and subsidiary. This simply involves adding like items from the different entities. When combining items, it is important to ensure uniformity in the classification of line items among the entities being consolidated to avoid discrepancies during aggregation. Our consolidation solution allows for easy mapping and aggregation of financial data by predefined chart of accounts. The fifth step is to eliminate the parent's investment in subsidiaries against subsidiaries' equity acquired. Sometimes the parent pays an excess purchase price over the subsidiary's net identifiable assets at the time of acquisition. The excess purchase price is referred to as goodwill and is accounted for as an asset in the consolidated statement of financial position. To achieve this elimination, the parent entity should maintain for each of its subsidiaries the record of the purchase price paid and the net assets of the acquired subsidiary at the date of acquisition. AARO Consolidation Solution can retain historical data related to investments and net assets for each subsidiary, allowing for easy reference and comparisons over time. Further on consolidation, it automatically performs elimination based on the recorded investment and net assets and accounts for the resulting goodwill or bargain purchase in the consolidated financial statements. The next step is to perform eliminations of intercompany transactions. The aim of consolidated financial statements is to present the financial position and results of operations as though the group of entities were one economic entity. This means an entity cannot report that it has sold or purchased from entities within the group, or it holds payables or receivables against the consolidated group entities. The consolidated financial statements should only include transactions with third parties, and therefore intercompany transactions are eliminated. Profits or losses from intragroup transactions that are recognized in assets that are still held in the group are also eliminated in full. AARO consolidation software can automatically track and match intercompany transactions, facilitating automatic elimination of the intercompany transactions and generate elimination of entries based on predefined rules. The final step in the consolidation process involves allocating profit or loss between the group company and the non-controlling interest, NCI, previously referred to as minority interest. The non-controlling interest is the portion of equity in a subsidiary not attributable to the parent. This allocation begins by determining the subsidiary's net income or loss for the reporting period and allocating the result between the group and the non-controlling interest based on the percentage of ownership. In the consolidated income statement, the total profit or loss is presented along with two separate lines showing the parent and the non-controlling interest allocation. In the statement of financial position, the non-controlling interest is presented within equity, but separate from parent shareholders' equity. AARO consolidation software automatically allocates profit or losses to the group and non-controlling interest using the percentages of ownership stored in the centralized database. Thank you for tuning into this video on the 7 steps in preparation of consolidated financial statements. Preparing consolidated financial statements requires a strategic mix of resources, including skilled personnel, robust systems, and efficient tools. At AARO Academy, we offer group accounting training that delves deeper into this subject. Consider enrolling in our upcoming IFRS group accounting training, where we will guide you through the consolidation process with practical case studies.
Additionally, visit our website to book a demo of the AARO consolidation software designed to simplify the consolidation process, minimize errors, and ensure compliance. Don't forget to like and subscribe to our YouTube channel for more content on ESG, IFRS, and financial reporting. Follow AARO Academy on social media to stay updated on new events and learning opportunities.